Pasture, Rangeland, and Forage Insurance, also known as PRF, specifically designed to protect the hay grower and the grazing guys. Row crop farmers have had subsidized insurance for years. PRF is designed for you. PRF is a heavy buy-up coverage that has previously been unavailable through NAP. Most of you would be familiar with the livestock forage disaster payments or NAP payments on your hay and grazing acres. With NAP, the county has to have a 50% loss for it to kick in, very low-level catastrophic coverage. PRF is a similar concept, but it is going to let us purchase all the way up to 90% of a 70-year average rainfall. Deductibles range between 10 and 30%. There are roughly 600 million acres that are eligible for this program. PRF is area revenue protection. It is not individual rain guarantee on your pasture. PRF is available for hay crops, whether it be grass, hay, or alfalfa. It's also available on your grazing acres. The only distinction is between grazing and hay. PRF is now available in all 48 contiguous states. Let's look at how this program works. Each little red dot on this map represents a NOAA-approved weather station. There are over 9,000 weather stations, with more and more stations being added each year. It's impractical to monitor all rainfall in every location, but a very good job can be done monitoring precipitation over a general area. RMA sets a base value per acre for grazing value. If RMA sets a grazing value of, let's say, $10, they will let you buy up to 150% or $15 an acre, or buy as little as 60% of that $10 an acre value. You do have flexibility on the dollar amount covered, but the base value is fixed and set by the RMA. Rainfall index is all based on a grid system. The grid lines run on longitude-latitude lines, and each grid is a quarter-point longitude by a quarter-point latitude, roughly a 12 by 17 mile grid, depending on where you are in the country. This is why we refer to it as an area revenue policy. We are insuring for lack of rain on any acre you have that fall between that 12 by 17 mile grid. Let's say your ranch is down here in the corner. Now your grid gets 1 inch of rain, but it all falls up here on the top. This is where the smoothing process comes in. They take 4 closest NOAA Doppler weather stations and identify where the rain was, and spread it out. The southern stations are reporting no rain, while the northeastern stations will have seen 1 inch of rain. You will frequently get rains that the grid misses, and you will miss rains that the grid gets. But since they have to smooth it out over the whole grid, you will find, year in and year out, that the data is very accurate and very fair. You will find that guys who have been using this for 5 years or more and watching the rain have no complaints. Also, the ease to be in the program versus the data they use to administer the program balances out to be pretty fair. All the data is collected by NOAA and reported to the insurance companies. Now that we have that figured out, let's look at how the program is used. Most areas have 2-month intervals starting in January and ending in December. You have 2-month intervals throughout the whole year that we can put coverage on. The rule here is that you can't double dip on the same month. Generally, you have to put at least 10% coverage per 2-month interval if you choose to use it, and at most 70%. The maximum ranges between 50% and 70% depending on your county. You will find the better risk management is possible when you spread coverage instead of dumping all coverage into 1 or 2 intervals. So how do we use PRF that sets us apart from others? We use software called RangeCalc, which takes those 2-month intervals in the whole year and combines all the NOAA data being used for the PRF program. We tell RangeCalc to pull the last 20 years of data on your specific grid. It starts running calculations to show us the best way to use the program based on percent of payment and net loss payments. So what the software is doing for us is taking these 2-month intervals and finding where the volatility lies. Here is a great example of this. Your first instinct is to put all coverage on June and July, which makes sense since historically they are the driest 2 months. However, they are not necessarily the most volatile months. Your driest interval is not always your most volatile. RangeCalc is showing us the volatility, shortfalls in rain that trigger payments. So we are able to use historical data to make informed decisions on the best way to manage your dry weather risk. PRF requires you to sign up by November 15th of this year for the next year's policy. A nice benefit is that premiums are not due until the end of September, after the end of the crop year. No money up front. What can happen if you have coverage in March, April, and it starts out extra dry, and you trigger a loss in that interval, they're going to take those lost dollars and fund the policy, meaning less or no premium payments. Note, rainfall data is not released until about 60 days after an interval ends. With RangeCalc, we can show you exactly what the past would have looked like for you using PRF, bringing visibility to your decisions. There is no reason to gamble on the weather anymore. Let us help you manage your dry weather risk.